So 2024 started off very well. I'm very happy about that because the end of 2023 finished very well. A lot of people were worried that that was going to be the end of the market rally. Very happy to see it continue in Q1. A lot of the positivity has come from exactly the same things that drove it higher in 2023 at the end of 2023, which is this anticipation that rates are going to be cut, that financial conditions are going to be made easier. And largely central banks have come through and said that that is the case. The bond market has struggled slightly with that narrative. We started off the year pricing in 6 interest rate cuts broadly within developed markets, and that's come back down to 3 interest rate cuts now where we sit at the end of Q1. And the bond market has suffered with that slightly. So you haven't seen the gains coming through from bonds that I think we'd all hoped, although high yield and corporate bonds have done well in comparison to government bonds. The equity market has done really well. What you saw doing well last year, that AI theme, that Magnificent Seven theme, has largely continued. But the thing that we're really enjoying at the moment is that you're seeing that broadening out of the rally. You're seeing a lot more sectors that don't have anything to do with the AI theme starting to see some of that attention, starting to see some of that positivity coming through. You've seen the likes of Europe doing well. You've seen the likes of UK's currently having quite a good time. You've seen small caps doing very well. Value is starting to do well. Now, these are all component parts of a diversified portfolio. It's not just about Magnificent Seven stocks. It's not just about US growth. It's about owning high quality assets from across the spectrum. And that's what we own. So our portfolios are reacting very well to that. We took a view at the beginning of the year that the market was going to carry on with its positivity because rate cuts had yet to come into the market, but the positivity was there. Central banks were telling us that that was going to happen. So we went slightly overweight equities. And where did we focus that overweight? We focused that overweight in the US, which has been a good investment to do over the first quarter. So we're very happy with positioning on the equity market side. We have a diversified book, which we think is really good. On the fixed income side, going back to that, we underweighted our exposure to government bonds on the belief that there was going to be some stress coming through the market there. We went overweight the corporate side. We went overweight some of the areas that we saw some real value in the bond space, and that again has done very well. So a lot of people will have seen some other asset classes behaving well or strangely this year. Bitcoin has been one of them. It's done extremely well. What you've also seen operating under the surface is gold doing extremely well. We're seeing a lot of central bankers moving a lot of their wealth into gold. There's a lot of speculation around why that's happening, but we're seeing gold at all-time highs. What we're seeing as an interesting dynamic is silver, which usually should outperform gold in a bull market, is not. So we're expecting some catch up there, and we're also expecting some catch up from the likes of gold miners and silver miners, where you see the gold miners, what they're exporting out of the ground would mean that they're increasing their revenue from that, and we're not seeing that reflected in the share price just yet. So we think there is a certain amount of catch up to be had in that area, which we're quite excited about. Japan's also been doing extremely well. The corporate governance scene is improving there, and we think that's still got room to run. You've got the central banks readdressing their negative interest rate policy as well, which I think is going to be beneficial to that economy. So we're certainly seeing some more areas of positivity coming through from different asset classes, which we think is really important. All in all, we're pleased with the performance that we've seen from our portfolios in the first quarter, but we're also pleased from the positivity that we've seen from across the entire market. We're pleased with the positivity that's come through in the bond market, specifically within high yield and corporates. And we're pleased with the equity performance that we've seen, because it shows a willingness from investors to want to invest into this market, to want to participate in this market. And we think primarily that that's going to continue. Yes, there are some questions around the fact that the equity market in the first 3 months of this year has gone up by nearly 10%. And I think that's ahead of almost most people's projections on where it was going to go. So we do think potentially there is an argument that the market might need to take a breather in Q2, and that could be reasonable, but we don't see an end to this positivity, especially when you consider that the US, UK and Europe largely on an economic footing are looking quite good. So there's a nice backstop there that the economics are stacking up, all the while central bankers are coming through saying they're going to be dropping rates. So the narrative is quite supportive for further gains, especially in the equity market. And we want to carry on benefiting from that. We want clients to carry on benefiting from that. So that's the way that we're going to stay as we move into Q2. But we're just going to watch to see if things take a breather and how we react to that.